All right, welcome back. It's Saturday morning, February 8th, 2025. I'm Daren Blonski. Join me is Chris Sipes. We're going to be talking on the markets and the economy, and of course, tariffs, and more tariffs. And what does that mean for the markets? Markets have been following a pretty interesting pattern lately, which I'm going to show you on the S&P 500. It's basically right now, Chris, you buy Monday and you sell Friday, because inevitably on Friday there's going to be talks of more tariffs, and then by Monday it will all go away. But anyway, we'll dive into that and more right after this. All right. I saw this meme too the other day. I think it's just about perfect.
Yeah, this was from Ben Carlson over at Ritholtz. And now, to be fair, it doesn't hit quite as hard because the tariffs did turn out to be short-lived. So, but he tweeted this out, I think it was Saturday or Sunday. So before the tariffs were over, or at least paused, I guess, kicked down the road. So it had a potential to be a high impact meme, and it fell just a little short because they were over midday Monday.
Yeah. By Monday, I think they were all on
before
the
the
phone
market
scrolling
closed.
together.
Yeah. So this one was hilarious. I think somebody replied to the meme with this, your shirt, I survived the 2025 global trade war, which was one day. Daren, we laugh only to keep from crying, right? Because it has been very chaotic. And I do want to acknowledge, boy, I don't know about you, but I had a lot of meetings this week of people genuinely very worried about, the environment, the markets, uh, the return of chaos and unpredictability and uncertainty. So those are all really real things that we're all working through. And I think it's instructive to remember that, investing is mostly a game of emotions, not a who's the smartest wins. It's those that can control their emotions, both on the upside and the downside. And, after managing money for other people for a long time at this point, I can say that it's probably just as hard to manage your emotions on the upside as it is on the downside. Um, and so we're constantly battling, the greed and fear, right? And you have to try to do your best to control that, right? Because look, there's always bad things happening in the market. There always will be, in the real world, I should say. And then the market responds the way it's going to respond, which is usually not the way you would expect it to respond. It's totally unpredictable. And so it ends up usually being a case of those that persevere and stay diversified and stay invested and, don't lose their emotions either on the way up or the way down, are typically those that tend to do well over the long run.
Well said, Chris. Well said.
Thank you. So we've got a pretty big fluctuation in sentiment this week. The AAII sentiment indicator, which is again where they survey fund managers and see, are you bullish, neutral, or bearish? We're back down to normal bullish sentiment, and we haven't seen that in quite a while. I don't remember. We kind of, at first, I think second week in January, I can't even remember what the headline was that week that we dropped so much down to 25, but 33 is actually roughly normal in this survey for bullishness. A little high on the bearish side, 42.9% this week. That's creeping up there on the poor sentiment. CNN Fear and Greed Index is at 40, which is the same as last week. Now that's a technical indicator based on how people are positioned in 7 different areas. And then Bitcoin, I thought you might find this one interesting, Daren, dropped all the way down to 44 fear, which was down from 76 extreme greed last week. And we did see a bit of a, vacillation in Bitcoin, but I didn't see anything kind of out of the ordinary. But I would say, we follow these indicators as contrarian, meaning the more cheerful people are, usually that's not a great time to buy in hindsight, at least short term. And if people are really bearish, typically, your ears perk up of like, hey, maybe there's an opportunity here to get in at a decent price because not everybody's scrambling to buy with both hands.
Yeah, we're going to talk about the chart here in a minute in Bitcoin, but I think the risk is certainly to the downside at the moment. Lots of really positive news coming out around strategic Bitcoin reserves this week, that President Trump is considering that there's a bunch of states that have now put together proposals floating the possibility of strategic Bitcoin reserves, etc. So I think it's just a matter of time. It could be one of those things where it's, buy the rumor, sell the news kind of thing. I think long term that bodes well for demand on supply, but in the short run, it could have certainly more volatility attached to it. And the chart's looking, I would say, weak-ish right now, and I'll show that here in a few minutes.
So we talked about tariffs a little bit with the opening memes, which was Monday. Fast forward all the way to Friday, which feels like a year's worth of news in 1 week. We got the jobs numbers, which were better than expected. And you would think good news is good news, right? Wrong. Good news is bad news, because good news in the jobs market means that the Fed is going to be, it's going to be difficult for the Fed to lower interest rates. And so we saw the unemployment rate tick back down to 4%. From my understanding, the revisions were quite a doozy for, I think it was November and December, something like there was actually 100,000 more jobs than what they expected or something of that nature. So it was like a massive difference, right? Those numbers, we have to remember when they come out, are not like down to the, decimal point accurate. I mean, they're not even within 6 digits of accurate. So that's huge. But anyway, we creep back down to 4%. That's bad news for the market because it means the Fed's going to have to be tighter. If the Fed's tighter, it creates a whole host of issues. Money's more expensive. The dollar's getting stronger, makes it tougher for businesses to make money, especially if they're selling abroad. So subsequently, the market sold off on Friday. And when I'm saying the market, I mean stocks, bonds, interest rates went higher. So it was, quite the week, finished off by that jobs number.
Yeah, I'm going to share this here in a few minutes, but last night, I don't know if you caught this. I sent you a link this morning, Chris, but the Fed posted their monetary policy report for February.
Yeah.
And lots of nuggets in there, and I'll show you some stuff that we can pull out of there. But I think the market should cue off that next week off this report.
Yeah. So like we've talked about, the new administration's coming in with the highest valuation stock market in history. Okay. So how much upside is left? Who knows? But also they're pretty far along in the business cycle if you're measuring by employment. And this is from Charlie Biello at Creative Planning. And he says 143,000 jobs were added in January. This was the 49th consecutive month of jobs growth in the US, the second longest streak in history. Okay, so now maybe we're going back above the previous highest streak, and this is just a blip in the road. But you can see here historically, if the numbers kind of correlate with historic numbers, we're long in the tooth in terms of the employment area. And you got to ask yourself, like, if we are making all these cuts in government, which we all know a lot of the jobs that were added in the last few years were government jobs, maybe that's how we avoided a recession, was the combination of pumping gobs of money in spending and deficits like we were in a recession. We absolutely turned on the spigot deficit spending wise like we were in a recession, and added a lot of jobs, mostly in the government sector, which is a reason why all these indicators were saying, hey, we should be going into a recession, around in 2022. That never happened. And it could be because of that, being patched up. So, here's another area where the administration, like, they're coming in, and we talk all the time about how it's not necessarily the political leaders that drive the markets. The markets have their own business cycle. There's cycles to interest rates. There's all these cycles, and there's things they can do around the edges that prolong them or shorten them. But it's not like they have full control over the business cycle, despite what they promote that they do.
It's interesting in that same report, Chris, that I was, I guess I'll just do this now, is in this same report here that I was telling you the Fed released last night. They were talking about, which I thought was so interesting, because we've heard so much political rambling lately and political back and forth that, the politicians are going to control inflation. And in the Fed report here, and you can see that the Federal Reserve states in their first sentence here in this paragraph, inflation rate over a longer run is primarily determined by monetary policy, and hence the committee has the ability to specify a longer run goal for inflation. So this is the Federal Reserve basically taking full responsibility for inflation, which is interesting, right? Because there's so much political rhetoric out there that, it's the politicians that are the ones who are going to bring the cost of eggs down, et cetera, et cetera, et cetera. That might be true on the margins or on the fringe, that their policies can impact it. But at the end of the day, it's monetary policy that drives these labor markets, that drives inflation. It's not what the politicians like to believe.
I bet those chickens have been a good investment for you, right, Daren? With the price of eggs.
Yeah, man.
What's your return on investment
15
there?
chickens, they've been pumping eggs out lately.
That's right. Hey.
Did you see that headline last night that in Pennsylvania, someone stole 100,000 eggs, and the value of that was $40,000? Okay, we're there now.
I did not see that. I did not see that. You used to have to worry about your catalytic converter. Now you got to worry about your chickens or your eggs.
eggs.
Oh God, honey, somebody took the eggs.
for our next crisis or pandemic or whatever, everyone's gonna be lining up at Costco buying chicken eggs, not the toilet paper.
Yeah. I guess it's the flu or whatever, but yeah, our local store's been empty on them a few times, so they are highly valuable. Maybe we should look into some funds that get some exposure to pasture-raised chicken eggs.
The chicken egg ETF.
Yeah. The ticker would be EGG, I'm assuming.
Yeah.
Okay. Enough dad jokes for at least a few minutes.
Financial humor is not funny, Chris.
Yeah, no. So where are we with the 2-year rate? Now, this doesn't include the jump yesterday. So let me just read my note, because there was a little bit of a jump yesterday, which isn't reflected in this chart because the chart was created yesterday. It does day before. So 4.298% is where the 2-year ended the week yesterday. And what you're looking at here is the purple line, the 2-year treasury rate, which is roughly what the market considers to be the correct short-term interest rate coming from the Fed. And then you've got the orange line there, which is the Fed funds upper limit. And you can see that, the Fed is technically a tiny bit restrictive, but not a whole lot, meaning that they're a little bit higher than what the market's 2-year yield is saying they should be if they wanted to, be neutral. They're supposedly striving for neutral. They've been tight to try to get a handle on inflation. They've been kind of saying, hey, we finally got a handle on inflation. We can start moving back towards neutral. And so, this is what the market's gauge is. It looks like the Fed, is about right there, which is why the the market is no longer really pricing in any cuts anytime soon from the Fed to the interest rate. And what's interesting is that interview that Scott Bessent did on Bloomberg was that, he mentioned specifically the 10-year yield, that they want to get the 10-year yield down. And we all know why, because that would, help with mortgage rates and credit card rates and car loans and, the general price of money in the market. However, they don't directly have, control over that, at least not in any of their operations that I'm aware of yet. Now, Bessent maybe has some tricks up his sleeve to get that rate down. But, I think we should definitely take into account what the administration says their stated goals are. And that's a pretty clear one, that they would like to get the 10-year rate down from where it is today.
What's particularly, I think, interesting about this chart, if you look in recent history, when this target rate kind of caps out, and then you've got the 2-year treasury rate, and we get this flat, and then you get basically the 2-year then right next to it. Like, you see these big drops happen where we hit recession periods. And I would say, if we took no other data points, like, this would tell us that it's likely that a recession is more likely than not, just based upon this chart in the near future, which I think you could easily construct an argument for the fact that we're watching a lot of government jobs get cut, and a lot of the jobs that we gained last year were not actual private jobs, they were government jobs. So if you cut that stream off, it would make sense that if a bunch of people are getting laid off, that happens on the margin, and that ultimately puts us into some degree of recession. The big question that I have in my mind is, what is the Trump administration, if they're going to cut all these government jobs, what are they going to do to replace it? How are they going to stimulate the rest of the economy? Cutting all these USAID funding mechanisms for various NGOs, it does have an economic impact, right? So you have to replace that somehow. Otherwise, things slow down because of it. And I think right now I've yet to see how they're going to pull that off. I would assume they've thought about that, but not.
Yeah, exactly. Like what that article that you'd sent about them, discontinuing QT and making some of those changes. Now, that's kind of directly at odds with bringing rates down, you would think, at least in the short term. Because if they're no longer buying treasuries at the same rate that they were previously, how is that rate going to come down in the short term? Now, in the long term, I think you would say, well, that's to get the U.S. fiscal house in order. And if they do that, then that will bring, in theory, that would bring rates down, because there would be less debt, to be supplying in the market. So, yeah, I mean, I think that however President Trump said it last Sunday, something like, there's going to be pain, right? If they're going to accomplish these goals that they say they're going to accomplish, it's most likely going to have to require some short-term pain to get there. And short-term usually doesn't mean one day. Doesn't mean just Monday.
Doesn't mean Friday to Monday.
Yeah.
Well, yeah. And I think that's what this chart's telling me here, right? When I just look at this chart on its face, I think a recession's more likely in the next 6 months, just based upon this. Now, it could be totally wrong. It could go the other direction. Things could totally change on here. But if we look at recent history, when the 2-year, 10-year on the downside get close to each other, we tend to see these quick rate reductions. And typically those are caused because we're in a recession. Now, can Scott Bessent and Donald Trump figure out how to engineer that without that recession? Because they want to get that 10-year down. And it's particularly, I think, meaningful for Trump too, because if you look at his life experience is in real estate, right? So he has to be very aware of what the 10 years doing to his ability to borrow, his ability to build, Like that's something he's been watching his entire life. So he's cued in on that.
Yeah.
I mean, at least you could presume he is.
Yeah, absolutely. You'd think if there's anybody that knows what they're doing, and how A leads to B leads to C, Besant would be up there in that realm. So, what we're looking at here is various indices over the last year, and you know, you look at FXI, which is the large Chinese stocks over the last year, have roughly doubled that of the US. Now, I think there could be a lot of reasons for that. I mean, probably chief among them is that their market got absolutely destroyed the year before. They were down 50+%. So there could be some, bounce off the bottom momentum. But it could also be the market sniffing out that maybe we're seeing peak US tech at this point, peak optimism. I mean, you literally had the heads of the biggest tech companies in the room during the inauguration. Like, if there's ever a signal of a top, gosh, I don't know what would be more so than that, of like peak optimism, peak, power, right? And my thought is, if all of these tariffs if we're gonna start a trade war, right? Large US companies receive about 40% of their overall revenues from abroad, different countries. So, of course, not all of those are we gonna be in a trade war with, but we're gonna be in a trade war with a significant number of them if things go as they look like they're gonna go now. If that's the case, what are those countries gonna do in retaliation, right? Is it easier to, go after a small US-based company? Or is it easy to pick on one of these top 7 that make up a third of the US indices that are sourcing, a lot of their product in these countries? If you're looking at a company like Apple, if you are, wanting to go after them from a regulatory standpoint, like China did with Google last week, to me, the targets on their backs are huge if we're going to start trade wars with these other countries. And they're the most at risk that I can see, given that they're priced for perfection. They have the most exposure to these foreign countries that we might be getting into a trade war with. To me, the most risk is right there in the market. Could be early on that, could be totally wrong, uh, not investment advice, but I do think it's instructive to kind of look at that and say, okay, if President Trump's going to be, rattling the bee's nest, where are people going to retaliate? Who's the easiest to come after? Now, despite what I just said, looking at the markets, since the election, would not say that small companies are going to have a chance at all, because that's the RTY, the yellow line here. The small US companies are down. I'm looking at a more updated chart over here. They're down 4.73, so about roughly the same since the election. So that's represented by the Russell 2000. Now, most of those companies are going to be US based, small cap companies. The emerging market companies, same thing. They're going to be more foreign based, smaller, less tech oriented, et cetera, et cetera. So those have also struggled. But interestingly, look at China has outperformed the mighty Nasdaq, and right behind the Nasdaq is Europe. And so I wonder if some of the strength that we're seeing there so far, is that, if the US is not going to be supplying a lot of this stuff, if there's more trade between Europe and China moving forward. I don't know, but the market knows better than I do. And at least so far, that theory of smaller companies benefiting, or at least not getting hurt as badly from trade wars, seems to not be playing out yet. It could be the fact that interest rates are higher. Maybe the market's pricing in the fact that a lot of those small companies have debt outstanding that they need to refinance, which is going to be a lot more expensive at today's rates. That could be offsetting some of the benefits that they wouldn't get from tariffs. But, if all these products and goods from other countries and these large companies are getting tariffs added to them, call it 10, 20, 30%, it's going to make it a lot harder for them to compete, with these smaller companies, you would think. I thought this was an interesting chart from Global Macro, and he says, these are the states, U.S. states, that are more or less dependent on other countries for exports. So the fuchsia or purple, I think fuchsia is purple, right, Daren?
Sure.
Maybe fuchsia is not purple. I don't know. Purplish, the pinkish purple, that's China. So Alaska, I'm assuming that's probably mostly energy and oil going to China. But you look at a lot of the Midwestern states, Michigan, North Dakota, South Dakota, West Virginia, Missouri, they all have a lot of exposure to Canada. Mexico, kind of more the southwestern states, a lot more exposure. But then you look at kind of the East Coast, and a lot of those states don't have much exposure at all for exports. So
I think it's particularly stark that DC has no dependence on Canada, Mexico, or China. But yet that's the center of decision making and power in the United States.
Yeah, it is interesting, and I think it's most interesting that if you took that middle swath of the country, that was very red during the election, and so good or bad, that those states have the most at stake for tariffs from an export standpoint in a trade war.
Trump doubled down on his statement yesterday that Canada is going to become the 51st state. So we'll see how long that lasts.
Yeah. Well, we'll see here where we put that extra star on the flag. That would be interesting.
Yeah.
My need for symmetry.
Well, hold up. We got Greenland in the house too, so we got to add two. Apparently.
Okay, that's helpful. At least we're not ending on an odd number.
It remains symmetrical, where we're going to put 2 stars. But then I would think Puerto Rico would be pretty teed off at that point if Greenland and Canada got in. But then Puerto Rico, like, hey, what's up with that? We've been hanging out forever, and you guys don't want to make us a state?
Yeah, true. Then we'd have 3. We're back to an odd number. I don't know. It's going to be tough for me. Now this chart, gold. So, one of the great things about investing is that, somebody said there's always a bull market somewhere. So no matter the bad news, right? The diversified investor is always happy and always sad, because there's always something in your portfolio doing well and then something that's not, right? If you're properly diversified, there should be a love-hate relationship with your portfolio. One of the love parts, at least here recently, is gold. This is over the last year, and gold versus the S&P. Gold is far outrunning, and we talked a little bit about returns since the election. So gold has left all the other major stock indices in the dust since the election, up just shy of 7.5% since November 6th. As measured by the GLD ETF. And so, there are assets that do benefit from chaos, instability, the fact that we seized, through sanctions, Russia's, financial assets. And so a lot of global central banks are now purchasing gold instead of treasuries. So there's a lot of demand for gold, going back to the year 2000, gold has actually outperformed the S&P, which is also a I think would be shocking to most people. But there are assets that can do well in chaotic environments, and actually benefit from those. So, that's the beauty of diversification, is that you can have some of those assets in a world of unknowns. The most aggressive strategy is to be diversified, because you're placing bets in areas where you're saying, I don't really know if this is going to do well or not. Especially you're especially aggressive when you're placing bets in places that have not done well, based on things that you're like, I don't think that could ever happen. Well, guess what? There's always next Monday or next Tuesday, because things happen every day that we never expected to happen before. So gold showing a lot of strength.
I'm still curious. Like, I keep seeing these ideas being floated of a 24-hour market. The one I saw recently, where they actually don't close the market at 1 o'clock Western, that it trades 24 hours, more like the crypto markets do. The most recent proposal I saw floated was that they'd still keep it closed on the weekend. And I feel like if they took away that Friday market close for the politicians, it would change their whole game, right? Because how many things come out after market close on Friday?
Yeah, that's true.
And that's what you'll see in the markets on the SPY here in a minute when I show the actual charts from the last 3 weeks. It's just like, it's almost like clockwork, right? Friday, something gets said, and the market, boom, goes down.
Yeah, that's one of the nice things about Bitcoin, is you can kind of see how the market's, sentiment is reacting in real time over the weekend.
Yeah.
Sometimes it's good, sometimes it's bad, because you're like, oh boy, Monday is going to be a doozy,
Yeah.
or wow, it's going to gap up on Monday. Now,
How
what
many
you're looking
Sunday
at,
evenings has Bitcoin ruined for us, Chris? Is like,
yeah.
oh man, Monday's gonna be rough.
Now, this may be what they call a chart crime. I'm definitely no chart expert, but what you're looking at here is the credit spreads between double B, so what they call high yield or junk bonds, so companies that don't have the greatest credit. How much are they borrowing money for above the rate of lending to the U.S. Treasury, which is considered excellent credit risk. So you got excellent credit risk versus not so great credit risk. What's the spread there? All-time lows, pretty close, right? So here's another area where the administration's coming in and things are priced about as good as they can get. I don't know how you can get much tighter than that between junk credit and treasuries. But you're also looking at the VIX, which is the volatility index that we look at all the time, in orange, and you'll notice that these two tend to spike with one another, meaning that the more volatility that's in the market, the more risk is apparent, the more investors require a higher spread on their money. They're not going to lend money to a poor risk if the whole market's falling apart. People don't feel like taking a lot of risk when that's happening. So usually when the VIX spikes, above 20 or 30, that's when people are kind of scared, and they tend to not be willing to lend money at such a cheap rate. So having said all that, as of right now, the market's not pricing anything bad in, right? Other than the fact that gold keeps going up, pretty much daily. The credit spreads and the VIX are still very, calm. So last one here, and this one's one of those charts where, well, first let me say what it is. It on the left hand side, it's showing the top 1% of households by wealth, and then on the right hand side, it's showing the bottom 50%, and it's showing that the top 1% tends to carry about 60% of their overall portfolio in equities or stocks, versus the bottom 50% tends to have a little over half in real estate. Now, I look at this and I'm like, yeah, but that's also because, the top 1% have a lot of extra money. They've already got their real estate taken care of, right? Like, at some point you get tired of buying houses where you don't really need them. And if you're going to invest extra money, it's kind of like the hierarchy of needs. Like once you have a house and food and you have extra money to invest in equities, right? But I also think it's instructive because we get asked a lot, very often, like, buying a house versus investing. And, overall, people should remember that, your primary residence isn't really technically an investment. Like it's some sort of a hybrid, maybe. Rental real estate, you might be, a little bit different, but as a primary residence, that's not exactly 100% an investment asset, because there's maintenance, there's taxes, there's all kinds of transaction costs, and et cetera, consumption. You're just living there. It's not paying you a rate of return, in cash flows or anything like that. So, anyway, instructive on kind of ways to look at wealth, depending on your situation and where you have to put extra money.
All right. Let's take a look at the SPY. So the SPY is a index that tracks the largest 500 US based stocks, and is often used as the shortcut when people think about the market, quote unquote, and how the market did. And if we look at the overall what's happening here, we're looking at the 4-hour chart. So this is, each of these candlesticks represents 4 hours in the market. So effectively half of a trading day. A little more helpful to see on a shorter time frame, to see market structure, to understand what might be going on, to read the tea leaves, as they say. And so the red candlesticks here represent where the market went down. The green ones represent where they went up. And so what I was saying earlier is, you can see that, give or take, let's see. So this would have been Monday in the market on the 17th. Or so that was Friday the 17th. So Trump took office on the 20th. So Tuesday, January 21st, market goes up and then sells off here, goes back down, goes back up. And you can see these like kind of tranches it's making. And very similar to the structure we actually saw after the election. My computer there we go. Okay, now we're going to work. So you can see these kind of peaks here. And so basically every Friday we're getting these announcements happening that then put the market back down after it builds up on Monday. And generally we're on we see kind of a downtrend, a short-term downtrend. But this particular structure looks bullish if we just go back to this period of time, where you can see these peaks and down, peaks and down, peaks and down. And then we get a breakout here. So based upon the structure I see right here, I think that's probably bullish in the short run, that we get a breakout coming here over the next week or so. Right now, I would say on its face, the SPY, that's fairly bullish. Now, in order for that to happen, we've got to see strong movement in the index, right? And so this is the looking at the S&P 500 from what we call a heat map. So a heat map effectively measures, helps you see from a size standpoint what the capitalization size of each of the companies in the S&P 500 are. And when you look at that, you can see that NVIDIA is just such a huge portion of the market, as is Microsoft, Apple, Amazon, Google. So as those go, so too does the market, unless all the stocks underneath are doing really well. You can see year to date. Let's look at 1 year to date performance. So this shows you how stocks have performed year to date. And you can see these big dogs have kind of been lagging year to date, except for Amazon and Meta. But the rest of the stocks underneath the hood have been doing actually quite well, especially banking sector. I mean, look at those numbers in banking sector, really strong. And finance tends to kind of lead the way as well. So that's a good indicator that markets are looking stronger. Finance is doing particularly well because interest rates are still high. The Amexes, the Visas are making a ton of cash right now because people are stacking money on credit cards. So when we look at a shorter time frame, We can look 1 year performance. And so this shows you this time last year, 2024 to February 2025. And you can see these big companies have really driven a lot of the market growth over the last year. So that's just kind of good to give us a sense of what the market's doing and how it's behaving. So I'd say right now, if we just take on its face, SPY, that looks like a bullish setup. Coming bullish, meaning positive, go up if positive's up for you. And I think that's good news. On the RSP, which is an equal weighted index, so it's not giving the same responsibility to each of the larger companies. It gives equal responsibility to all 500 stocks. And this helps you kind of see a little bit more what's underneath the hood. And this is a little bit more concerning to me. Let's look at this on the daily chart. And you can see here, certainly looks like we have a downtrend in motion. We have consolidation. We'd be looking for a breakout here, but I would say this is generally a weaker looking chart than the SPY, which tells you just that across the board, the market is weaker when you take out the X factor of these bigger companies really driving the market. So that's helpful just to always kind of look at both those to understand. But we're certainly have been going more or less sideways since give it September. We've just kind of been in this range here, but it looks like we're getting ready to either break out up or get rejected, go back down. Support really sitting. There's a lot of support here at 175 on this index. So I'm not particularly concerned at the moment. Now let's take a look at NVIDIA chart, right? This was the big chart a couple weeks ago when all of a sudden we saw this DeepSeek come out, and NVIDIA was less important because DeepSeek innovated in a way that would demand less chip usage, and they could actually use less sophisticated chips to run AI. And that really hit this stock hard. And it's just been hanging on this very important moving average, simple moving average on the daily chart, which is the 100 simple moving average. And it's just sitting there right now. So we'd want to see NVIDIA really kick back up in a significant way. I think some of the surprise is being worn off in the market with DeepSeek. I think people have now dug into it a little bit more and realized that, yeah, there's some truth to it, but it's not completely a slam dunk. Like perhaps maybe people thought initially. We need to take a look at the 10-year when it comes to the bond market, because this we talked about earlier, and Scott Bassett and Donald Trump have been talking a lot about trying to get this 10-year down. We don't want to see a high 10-year for real estate, for economic productivity. It's a slow grind. If you've gotten inflation, you want higher rates to get the inflation out of the economy. The Fed's been keeping, and they kept the rate neutral, or not neutral, but they kept it where it was at from last week. And we did see the last couple of weeks, we've been seeing the 10-year go down. We saw strong yesterday, Thursday, Friday in the 10-year, but it looked like it stopped right here at that 50 period moving average. So I'd say the downtrend's still on. You've got a cross on the 20 moving average and the 9 EMA, which is an important trading average, and that's down. So I'd say we're still looking at a down 10-year, which actually bodes well. We want to see for bonds. And why is that important? Well, unless you're an investor that's all in equity, all in stocks, if you have any bond exposure at all, it's been an absolutely brutal 3 years. We have not seen, we got clobbered when rates went up, and we just haven't really seen that rebound in the ag. Probably won't see that significantly until that 10-year drops. That's why we've got to watch that 10-year closely. And I would still say that even amidst everything, that downtrend is still on, but it's looking closer to breaking out in the ag, which would then feed into my thesis we were talking about earlier when we were looking at that other chart on the 10-year or on the 2-year and the Fed fund rate, saying that, yeah, a recession is a likely possibility at this point. We could see that. And it especially makes sense from just from a macro perspective when we're watching all these government jobs be obliterated because we're moving this aid from USAID off, and that impacts all the NGOs. That has a lot of downriver impacts. And I think that, like him, hate him, whatever, with Donald Trump, like, he makes quick decisions. And I don't know that the downriver decisions are always understood, or impacts are always understood. And that's just the way life is, right? Life is complex. There's a lot of complexity to life. And one decision here could impact a lot of other things downstream. And it's really difficult to tell what that downstream impact will be, because you don't actually even know what it will be. And any economist, you take a guy as smart as Scott Bassett is, he's the Treasury Secretary for Donald Trump. Like, he's a brilliant man and a great trader, and has been very successful in his career. And yet, like, it's a new economy. There's new things. There's new aspects to it. You never know what that economic input, what that output will be. And that's always the risk of making any quick decision when it comes to the economy, to the markets. And that's why we have to take the markets a day at a time, right? We can't get too far ahead. We try to look at the charts, and the charts tell us certain things, but we never really know what the charts are going to say into the future. And we call that the right side of the chart, right? We don't know what the right side holds. All we can try to do is deduce a pattern based upon what we've seen from the past, but there's no guarantee of that future. And what you can see right now with the ag is that downtrend is on, but we're looking closely at a breakout. Notice how these important, this 9 EMA and this 20, this red line here, are turned up. And you can see how this 100 simple moving average is turning up. The simple moving averages are turning up. I read this chart right now. Yes, we're still in a downtrend, but I think, based upon what I see, this is going to be in the bottom of the bond. And Chris, market now, Chris, you've been doing this with me for 4 years now. We've been doing these videos. I don't often tell you that, hey, I think I see the bottom of the bond market, right? How many times have you said that?
I know. I fell asleep there for a few minutes, and then you woke me right up. I'm like, did he just say the bottom in the bond market?
Yeah.
Oh, that would be something.
So I think you have that, right? From a chart perspective, I like this as the bottom, or at least in the short to medium term. And the fact that we're coming up against this moving average, or this downtrend line, and we've got rejected, and we just got a rejection, but we're hanging here, and we've got turned up simple moving averages. So I think we get a breakout in the bond market. I think the 10-year is going to continue going down. And I think that's going to help those diversified investors, which would be so great to get some relief for people who have an actual diversified portfolio. Would not be as good for those people that piled all their money into NVIDIA and have had incredible returns, but at the same time have exposed themselves to a lot of risk. So keep that in your bonnet for whatever you want to make of it. Apple, you can see. So if you take those big seven, we got Apple, right? And just take it on its face. Let's just take it on its face here. We got a downtrend. Let's take Microsoft. We got a downtrend. Let's take NVIDIA. We got a downtrend, right? So all the makings of that equity part of the portfolio rolling over some and seeing less strength there are here. Like, I see it in the charts. And I'm seeing the bottoming effect happen with the ag. And then you take gold into that equation. So gold, Chris talked about this earlier, how it's just been an outstanding return. It's done really well. You can see that going up. There's so much purchasing going on by all the central banks. And part of the reason with that is the philosophy is that if we have some kind of economic regime shift, economic calamity, etc., the more gold you hold, the bigger the seat at the table you have. And that's, I think, driving a lot of the gold trade and the insecurity. And now that we've had the 10-year going down, that's bullish for gold. If 10-year continues to go down, that's bullish for gold. And then the ag goes up. So those are risk off assets. I think you've got the makings of that right now. And it just makes sense to me, given that now we're seeing all this tweaking. Let's call it tweaking. I don't know what you want to call it, but we'll call it tweaking going on with the federal government in the funding and the way the feds have been funding all these different agencies, like them, hate them, whatever, that has an economic downstream impact, right? So that money going out of USAID and all these other organizations, as wasteful as it is, still acts as a stimulus. It still works its way into the economy generally. Fortunately, it probably goes into the pockets of the rich instead of being fairly distributed, but it still works its way on some degree into assets like gold, assets like stocks. You start capping all that stuff off, it's going to change things. Now, can the Trump administration then springboard it, right? Can they move that over to something else to stimulate the economy? That's going to be their challenge. You can't just cut it off and do nothing, because you do that, then you definitely are going to get yourself a recession, because so much of our GDP has become government spending, fiscal spending. So much of our GDP has become employing government workers. There's a challenge there that they have to watch. So I would say on its face, I would say I'm bullish in the short term for the S&P for another breakout. I'm looking really closely though to top here in the near future. I'm bullish on risk off assets. I think they're starting to show patterns like the ag that lead me to believe that we might get some more diversification appreciation in the portfolios. I'm generally seeing a 10-year continue to go down over time. I think the political will is there. I think that makes sense. But we've got to see inflation go down to see any marketable move there. All right. Let's take a quick look at VIX, which is just looking at volatility, looking at how complacent those who trade the S&P 500 futures are, looking 30 days out, and it looks fairly complacent at this point, which would speak well for, in the short term, a breakout in the S&P, things going a little bit higher, but doesn't speak so much if we get some kind of a event here in the near future. All right, last one, we're going to take a look at oil, and so if we're looking at U.S. crude, I don't really like that chart. Let's go to a different chart here. We're going to go, there we go. All right, so let's take a look at oil. We've been talking a lot about this breakout that we thought might happen, and you could see this winding up. We were talking about all through the fall, and then boom, we got that breakout, sure enough, and it got rejected. So I think on its face there, the fact that it was so swiftly rejected above trend line like it was, and then it's going back down to test this support line at 68. I suspect, given the other things I've talked about, ag and 10-year going down and gold going up and oil getting a rejected breakout, I think it's very probable that oil is signaling to us that we see that slowdown, that recession happening, going back to that 2-year chart that Chris was showing earlier. Oil goes down if you've got more on the market and if people are driving their cars less. And I think just the fact that the Trump administration is going to be more pro-oil, more drill, that's going to create more supply. If demand doesn't keep up with supply, then you have issues, right? It's not great just to say, hey, go drill everywhere and pull a bunch of oil out of the ground, because that could potentially really impact the cost of oil, which has downstream impacts, quite literally. Anyway, that's interesting. We'll continue to watch it. And for there, we're going to leave it there. And we'll be back next week to wrap up the markets. Have a great weekend, everyone. Take care.